Welcome to Value Added, the real estate podcast where we speak with the brightest minds in the world of real estate who provide, create, and realize value in an ever-changing market. If you're a real estate professional delivering value to your clients, an investor creating value not seen by others, or a busy professional who passively invests in real estate to grow the value of their hard-earned dollar, then you're in the right place. And now your host, Nick Walters.
Hey gang, welcome to another episode of Value Added, the real estate podcast. I'm really excited about today's episode. I'm chatting with Brian Burke. Brian is the president and CEO of Santa Rosa, California-based Praxis Capital. Praxis is a real estate private equity firm that he founded in 2001. Over that time, they have acquired over 750 properties, including over 3,000 multifamily units. Acquired asset classes include single-family homes, self-storage, mixed-use, and large apartment complexes in multiple states. Brian has arranged well over $500 million in debt and equity for Praxis acquisitions. Praxis's current portfolio exceeds $200 million of real estate assets under management. Finally, Brian is the author of The Hands-Off Investor, an insider's guide to investing in passive real estate syndications. He's also a frequent public speaker at real estate conferences and events nationwide. So without further ado, let's get on with the show. Brian Burke, welcome to the show. Good to have you.
Hey, it's great to be here. Thanks for inviting me.
Tell the listeners a little bit about who you are and how you got to where you are today.
Well, I'm the CEO of Praxis Capital. We're a real estate private equity firm based out of Northern California. I've bought over $500 million of real estate in my career, and now we own about 3,000 units across the country. But it sure didn't start that way. This came from humble beginnings with just me doing some house flips back when I was 20 years old, working in a grocery store, and built a business that ended up after the market collapse in 2005 doing over 100 houses a year, and multifamily all across the country, and all kinds of growth happened during the 2000s for me. So kind of started really small and made something out of it.
You started your real estate career in 1989, is that correct?
That is right.
So what were you doing from 89 to 2001 when you started Praxis?
Yeah, so I was just doing the house flips all on my own. Didn't have a business name, no company, nothing like that. I was just buying houses, fixing them up and reselling them. I was buying on the courthouse steps at foreclosure auctions, and then we were fixing them up and selling them. So I did that for, almost 10 years. Actually a little over 10 years before we formed Praxis and decided to make a legitimate business out of it.
You're based in California. You don't currently own any assets in California, I don't believe. Was there a time that you did have a portfolio of assets in California and you have since exited? Tell us a little bit about that transition.
Yeah, I really dislike California as a place to invest for a number of reasons, but we actually do still own some real estate here. It's not a primary focus for us on our multifamily platform, but it is our primary focus for our single family platform. So all of our house flips have been, well, not all of them, but most of them have been done here in California. We still have a couple of rental homes left after the market crash. When the market bottomed out in 2010, I started buying single family homes to rent out, and we bought about $15 million worth of single family homes in the San Francisco Bay Area. I think I have about 4 left. We started selling them about 2 years ago. The idea was hold them for 5 years, see if they double in value and then sell. Well, they doubled and a half in value. So we did pretty well on that trade, but now we're selling out of that. So almost nothing left in California except for a few house flips now. But our multifamily platform is based primarily in Arizona, Texas, Georgia, and Florida. That's where we own the majority of our multifamily assets and still have a few single family things here in Cali.
Let's talk about your multifamily business as it relates to coronavirus. I think my last count, we were in week 13 of the quarantine. You were on Michael Blanc's podcast back on April 6th. So That's about 60 days ago. And you were talking about a couple pretty important things. Number one, you had stated that the most important thing in the short term was going to be renewing leases, retaining your tenants, and you're projecting no rent increases going forward. Tell us a little bit about those comments and how everything has kind of panned out this last 60 days with rent collections, tenant retention, renewals, that sort of thing.
Yeah, I still stand by those comments today. I think it was really important to try to retain residents. We were unsure how we were going to do with leasing velocity amongst a shelter-in-place order. Of course, collections were a primary concern. Um, much to my surprise, the real estate business has one thing that it's very good at, and that is surprising you. In this case, the surprises have been pretty good. I really was bracing for, a large reduction in collections, but we didn't see that happen. We actually had record collections, all-time record collections at several of our properties in April. We're maintaining flat for May. We had an overall increase in collections portfolio wide April over March. So as far as collections went, we actually did pretty well. Uh, for leasing, tenant retention was very important. We were doing flat rental increases or flat lease renewals with no rent increases for our residents. That program was very successful. We saved a lot of notice to vacates using that practice. But leasing velocity actually stayed pretty robust. We actually signed I think it was 70 or so leases in April. We set a goal to sign 100 leases in May, and we signed 99 leases in May. So
Hmm.
really good for our 3,000 unit portfolio. So we did really well with leasing. A few things that surprised me is we had several residents that had pre-COVID delinquencies that came current. Even despite eviction moratoriums, people were feeling a little flush with cash after getting their stimulus checks, unemployment bonus benefits. Right now are allowing people to earn more money than they made when they were working. So we're seeing people keeping up and catching up on their rent. So far so good actually.
With regards to another comment, transactional velocity grinding to a halt, I think we've all seen that. Underwriting deals today, how is it different from how you were underwriting deals 90 days ago?
Well, the most significant difference is we're underwriting, a couple deals a week instead of a couple deals a day. So that's probably the big change that we've noticed. But so we're underwriting to zero rent growth for the first 2 years. We're underwriting to in-place newest leases as far as rental rates, where we used to use neighborhood comparables for other renovated units. So we're not counting on any post-acquisition rent bumps. We're underwriting to an increased bad debt, increased vacancy, and increased concessions during the first year and maybe in the first 2 years. I think most importantly, it just comes down to that post-renovation rent. We're really not looking to renovate right away. We're planning our renovations for year 2 to 3. So instead, where the typical business model might look like, buy the property, start renovating units, have all units renovated within 2.5 years, resell by year 3. Instead, now we're looking at buy now, sit on it for 2 years, monitor collections and maximize operations to the extent possible, and then do the renovation and sell at year 5. So we're kind of pushing everything back 2 years.
With conversations with investors who have been investing alongside you for several years, you've had a similar business plan of a 3-year hold before a liquidity event. How has that been received from the bulk of your investors?
They haven't really noticed a change from us. Our story has always been consistent. So I call myself a buy and watch investor. We buy the property, we improve it, and we watch the market for the optimal point to exit. So we've told our investors since day one. I mean, for 20 years, we've been telling our investors, this is how the plan works. You invest in this asset. We've underwritten it for a 10-year hold. If everything works out great, we'll probably have this sold in year 3. Uh, if we can sell in year 3, we will. If we have to, if we need to wait 5 years, we will wait 5 years. If we have to sell in 10 years, we will sell in 10 years. So really for us, it's like, we want to hold as short as possible, but everybody that invests with us is prepared for a 10-year hold. So this isn't really much of a story change, and chances are we still could sell in 3 years if the market gives us an upside surprise. I have a feeling that we haven't even seen the real shoe drop yet, and that the real impact to commercial and multifamily real estate has yet to happen, especially multifamily real estate. Commercial really kind of took a hit day one. Retail, office, hotel was the first one to suffer. Multifamily is going to be the last one to suffer, but it hasn't suffered yet. It will. It just hasn't yet.
Tell us about a deal you've structured recently, or go back to your record several years, where you and your team were able to unlock significant value that may not have been seen on the surface of a deal.
I think the best example of that is a property that we bought in Atlanta, Georgia, about a year and a half ago. It was a real interesting deal because we got a lead. It was actually a marketed deal, which we don't buy many of those. Usually everything we buy is off market, but there was a marketed deal that we toured. We put in an offer, and we thought that we had a few different ways to uncover some value. But just after we put the offer in, the value that really got unlocked was the property directly adjacent to it came on the market. So we chased that one as well, put in an offer on that one, and ultimately we ended up buying both properties. And the real value add here was, separately they were, one was 255 units, the other was 284 units. Way back when, this used to be one property, and what they did was they just put up a fence across like a connecting driveway, and then operated them as two properties. And so when we bought them both and had them both under control, we combined them back into one property. We shut down one of the leasing offices that was being run out of an apartment unit. We converted it back to an apartment unit we could rent out. Now we run it under one leasing office under one flag with one staff instead of two staffs. And the expense reduction that we saw was enormous because we didn't have to have so much parallel and duplication. That together the two properties threw off a ton more income than they did when they were being run individually. I think we bought the two for around $40 million. We were actually talking with a lender about refinancing, and they're talking about refinancing us at $40 million, and that being at about a 75 LTV. So, probably creating about, a little over $10 million in value in a year and a half. Pretty good, I think.
You're vertically integrated, is that correct? You have your own in-house property management company?
Yeah, that's right.
Did you use the same team for that property? The same staff that was maintaining it daily, the same maintenance guys that were turning the units?
We did. We kept most of the staff that was at one property and some of the staff at the other property to combine them to make one new staff that was smaller than the combined staff was before. Yeah.
Let's head over to the hard-hitting questions. These are the questions that we ask every one of our guests. First question I like to ask is, what is your why?
My why? Well, I really enjoy this. And if I wasn't doing this, there's really nothing else I'm qualified for. I mean, I guess, originally I thought I would be an airline pilot, and that was the direction I was going. So if I couldn't do this, that's what I'd be doing. But why is this is just what I like to do.
Besides your alarm clock, what gets you out of bed every morning?
The fun that I get to have by doing this business. I get to have a really good time interfacing with our investors and with brokers and sellers and lenders, and just kind of putting this whole thing together. And that gives me a ton of satisfaction. So I actually look forward to getting up every morning and getting in here.
We're going to talk about your book that just came out last month. But besides your book, what is a book that you've recently read that has significantly impacted your life?
It's probably the book that had the most impact on my life. I read 20 years ago, and that was Rich Dad Poor Dad. That one really helped me understand my why, as you just asked. I read a good book recently called Upside. It's a book on demographics, and which is a really interesting book because real estate really is a lot about getting in front of population movement. And I always say that we like to invest in places where people are moving to, not where they're moving from. And learning about demographics and how to quantify those population movements was pretty interesting. So that was a real interesting book. Wouldn't say it changed my life, but certainly was a pretty interesting and relevant book to what we're doing.
Tell us about the book that you authored that just launched last month.
Yeah, The Hands-Off Investor came out last month. I'm really excited. It's my first book. I've gotten some great feedback from people that have read it, so it's really rewarding to see that people appreciated what I was able to put into words, and really I was I felt that there was no resource out there to help passive investors who are investing in real estate syndications do it the right way. There was plenty of books out there to teach people how to be a syndicator, how to raise money from other people, how to invest in real estate using OPM, as they call it, for other people's money. But there was no book for those other people to show them, like, hey, you're going to put your hard-earned dollars in someone else's hands for them to do a real estate investment and hope for the best. You better know what you're doing and take time to do your due diligence. But there was no resource to teach people what that due diligence was. So I decided to change that.
How do you like to pay it forward?
My favorite is through our charity that I co-founded with Jay Heinrichs. It's heroeshome.org. Our mission is to raise enough money to provide a fixed up home free and clear to a U.S. service member, veteran, or first responder. And we're super excited about it. We're well over 2/3 of the way to our fundraising goal. We've got great partners on board to supply us with that home, and it's just really super exciting. So that's my pay it forward.
Any listeners can go to heroeshome.org and contribute?
They can, yes.
Fantastic. Best piece of advice that you would tell your 21-year-old postgraduate self?
To just believe that it's actually going to happen. It's funny when I was 21 years old, I just started investing in real estate, and I wasn't sure it was going to amount to anything or that I was going to be successful. I had a lot of frustrations along the way and failures, and found it was really difficult to break through to get into the business. And it's really easy to want to give up. Thank God I didn't. And I think what I could tell my 21-year-old self now is you just have to keep the faith and believe, because if you don't give up, incredible things will happen. And I never realized how incredible, but it really can happen.
Brian, how can our listeners learn a little bit more about you and get a hold of you?
Great ways. Biggerpockets.com. I write articles for the blog. I've got the book on Bigger Pockets. You can check out the book, The Hands-Off Investor. I frequently answer questions on the forums on biggerpockets.com. So that's always a great way. And then, of course, there's our company website for Praxis Capital. It's praxcap.com. That's praxcap.com.
I've been a member of Bigger Pockets since like 2008. So that's how long that I've recognized your name. Thanks so much for adding your value today, Brian.
Yeah, thanks for having me on. Had a great time. Appreciate it.
Thanks for listening. If you enjoyed this episode, please make sure to leave a rating and a review, which will help us introduce the podcast to other listeners. Also, don't forget to subscribe to our YouTube channel, which will give you access to other episodes you may have missed. Have a great day, and we'll talk to you next week.